Welcome. Today we will discuss environmental, social, and corporate governance, commonly called ESG. This session will explain what ESG means, why investors and regulators demand it, the main global standards like the Global Reporting Initiative (GRI), the International Financial Reporting Standards (IFRS), International Sustainability Standard Board (ISSB), and the Task Force on Climate-Related Financial Disclosure (TCFD). We will also touch on the Nigerian roadmap. Please expect practical steps, examples, and authoritative sources. Let's now move over to the slides for more interactive session. Okay, we'll start the slides by answering the very important question before us. What is ESG? ESG is simply environmental, social, and governance. It is a framework that evaluates how companies perform beyond finances. Companies are basically out there to make profits. But what are the other expectations that are required of you as a corporate entity? We'll start by taking a look at what the E stands. The E focuses on environmental matters like emission and energy. On the other hand, the S in ESG covers social issues such as labor practices and community impacts. Then the last but not the least, the G is addresses governance. That is how a company is directed and controlled. Investors use ESG data alongside financial metrics to evaluate risk and long-term performance. This framework has moved from being optional to being a core business expectation globally. So it's very important that as a business person that you incorporate ESG into your framework in order to stand a chance to compete globally. Then the next question is why ESG matters. Why is it necessary for a corporate entity to, incorporate it into their framework? A strong ESG practices reduces business risk. It also attracts investors and lowers borrowing costs and also protect brand reputation, which is very key for business growth. For example, investors now assess sustainability data before committing capital. Regulators are also demanding transparency. Studies by firms like McKinsey and company confirms that businesses integrating sustainability can outperform peers, because that's one of the things that will keep you going. If you incorporate all these practices and your practice become sustainable, investors will now look at you and say their money will make more difference with you than your peers. Then beyond compliance, ESG also creates opportunities, also enhances energy efficiency, reduces costs, and also good labor policies improves productivity. When your workforce is well taken care of, they become more productive and innovative. And innovation in grown product opens new market. ESG is therefore both a compliance issue and a growth driver. So if you really want to grow beyond your peer, just like I've mentioned earlier, ESG is one of the things that you have to incorporate into your corporate framework in order to ensure success. Let's now take a look at ESG pillar. We have already defined what ESG means, that it has there are 3 pillars, which the E, the S, and the G comprises. Now we will now start with environment. The environmental pillar considers how a business interacts with nature. It includes greenhouse emission, energy use, waste management, water consumption, pollution, and biodiversity impact. All these affect the society. So how you manage them is very important. It's very important. Regulators and investors expect companies to measure Scope 1, Scope 2, and Scope 3 emission. Scope 1 covers direct company emission. Then Scope 2 covers purchased energy, while Scope 3 includes supply chain and customer use. So all these will have to be taken into consideration. It depends on the kind of emission that your company is engaged in. Some companies can also be involved in all 3, from production to the final consumption of their product. So addressing climate change, pollution, and resource efficiency are no longer optional. They are core to risk management. Because in each country you have environmental regulators that can clamp down on your business operation if all these are not put in proper check. The next is the second pillar, which is social. We have talked about, it's ESG, environmental. Then we're now talking about social. That's the second pillar of ESG. The social pillar assesses how a company treats its people and communities. How does your company interact with its people and the community they serve? It's very important. No investor will want to do anything with a company that treats its people shabbishly and also without respect for the communities that they serve. And this includes employees' health and safety, fair wages, diversity, equity, and inclusion. Customer protection is also part of the social expectation. Community relation and respect for human rights in supply chain, very important. All these has to be looked into by any business that wants to be taken seriously. And also poor social practices like that can cause a strike, litigation, or reputational damage should not be tolerated in whatever form or guise. Best practice requires fair labor policies, grievance channels, and transparent supply chain oversight. Regulators and large buyers increasingly require proof of compliance with social standards from their suppliers and partners. So if you really want your buyers or your investors to take you seriously, it's very important that you ensure that your social policies are well intact. They are well intact in order for them to know that your people and the community you serve are topmost at your policy. Finance, profit, good, but what of the people that generate the finance and also the community they serve? Are you taking good care of them? It's a very big question. Then the next is the G, the last but not the least. We've talked about environmental, the E. We talked about social, the S. Now let's talk about governance, ESG. Governance refers to the structure that guides decision making in your company. It includes the independence of the board of directors, ethical business conduct, executive compensation, shareholders' rights, internal control, and anti-corruption measures. Do you have all these in place? It's very important. Without it, even the principal idea of profit might not even be achieved if all these are not put in its right perspective. So investors view governance as the foundation for ESG because weak oversight undermines environmental and social commitment. This simply means if your house is not in order, how can you now be able to affect the society? You cannot give what you don't have. You can only give what if you have good policies, good decision making. Is the decision that you have made within the board that will now be implemented in the society. So it's the foundation of ESG. So it's very key when you are drafting your articles of association that you take serious measures in order to put in place policies that will affect not just how you successfully run your company, how it also affects the society and your community in general. And effective governance ensures accountability, prevents fraud, and aligns management incentives with long-term sustainability. And also good governance signals to the market that ESG disclosures are credible rather than public relations exercise. Okay, let's take a look at global ESG standards. There are multiple global ESG reporting standards. The standard that companies are expected worldwide to maintain. You have the Global Reporting Initiative, widely used for comprehensive sustainability reports. You also have the International Financial Reporting Standard, International Sustainability Standard Board, which sets the investor-focused disclosure standards. Then you have the Sustainability Accounting Standards Board, which provides industry-specific ESG metrics. There is also the Task Force on Climate-Related Financial Disclosures, focusing on climate risk and governance. Then also formally there is the Carbon Disclosure Project, used for climate and environmental reporting. Let's now take a quick look at the regulations and mandatory reporting. Regulation is growing fast. The European Union's Corporate Sustainability Reporting Directive makes sustainability reporting mandatory for large firms. Also, the IFRS International Sustainability Standards Board is providing a global baseline that many countries, including Nigeria, are preparing to adopt. Also, the Nigerian Securities and Exchange Commission and as well the Nigerian Exchange Group are aligning local requirements with global standards. So it's very important that as a company listed on the Nigerian Stock Exchange, you start adapting some of these global standards before it becomes mandatory. Companies should prepare now because voluntary ESG reporting will soon transition to mandatory disclosure with penalties for non-compliance. So it's very important that you take this initiative early enough. It's not a mere thing. It's something that will grow your business and also make your investors see you in a more serious light. Okay, we now take a look at materiality in ESG. Materiality defines which ESG issues are important to disclose. Financial materiality as used by IFRS ISB focuses on what affects investors. On the other hand, double materiality promoted by Global Reporting Initiative and the European Union considers both financial impact and the company's impact on society or the environment. To decide, businesses conduct materiality assessment, mapping stakeholders, rating issues, and aligning priorities with their strategy. This helps irrelevant data, and it helps avoid irrelevant data and focus more on what matters. For example, climate risk for oil firms and labor practices for manufacturers, which is very key to this specific industry. Okay, we'll now take a look at ESG key performance indicators. Key performance indicators makes ESG measurable. For example, it includes, for instance, tons of carbon dioxide equivalent emission, liters of water consumed, lost time injury frequency rates for workers' safety, staff turnover, and the percentage of women in leadership roles. These are some of the things that you will have to use in order to measure your performance with regards to your ESG adaptation. Then governance key performance initiative might also include board independence and the number of corruption incidents. So that's with regards to governance, because ESG has 3 components. Governance is for the board, that's internal operations of the company. So you have to choose your own key performance indicator relevant to your industry, measurable and comparable to peers, so that you will know how you are performing with regards to your quest in order to be compliant with regards to ESG. Investors and regulators want clear numbers. They don't need vague promises. So your key performance indicators are central to credible environmental, social governance policies. Let's take a look at data and assurance. Collecting ESG data requires a reliable system. Many firms use enterprise resource planning tools or Internet of Things, sensor for energy and emission tracking. So if you are into emission of energy, you are into production, it's very important that you integrate enterprise resource planning tool and Internet of Things, so that You can monitor the energy emission that you use. And human resource information system can provide labor data. As ESG reporting becomes regulated, third-party assurance, similar to financial audits, is increasingly required. Assurance follows international standards like ISAE 3000 or AA 1000. And also, verifiable data builds investor confidence and prevents accusation of greenwashing, which occur when companies exaggerate sustainability performance without evidence, without key performance indicators. So it's very important that you have your key performance indicator to know exactly what you are doing, so that it will be easy for you to convince investors of your compliance with environmental, social, and governance policies. Also, let's now take a look at how integrating ESG into your corporate strategy. ESG is most effectively when integrated into business strategy. This means setting science-based targets, linking executive bonuses to ESG results, allocating capital to sustainable projects, and including ESG risks to enterprise risk management. Scenario analysis, often recommended by the Task Force on Climate-Related Financial Disclosure, helps plan for climate impact. Companies that embed ESG into their strategy not only comply with regulators, but also innovate attractive investment and build resilience against market disruptions. Okay, let's now take a quick look at Nigeria's ESG landmark. In Nigeria, just like we have mentioned earlier, the Securities and Exchange Commission has issued sustainable financial principles. The Nigerian Exchange Group, formerly the Nigerian Stock Exchange, provides sustainability disclosure guidelines for listed companies. And also, government regulators have also announced a roadmap to align with International Financial Reporting Standards, International Sustainability Standards Board. So Nigerian companies, particularly in oil and gas, banking, and consumer goods, should begin preparing for mandatory disclosures. It's very important. So early compliance builds confidence, investors' confidence and trust, and positions Nigerian firms competitively in global supply chains. Okay, let's take a quick look at some of the pitfalls and greenwashing. Many firms fall into pitfalls such as reporting weak or unedited data. That's investors will not take you seriously. And also, they announce targets without timelines, or focusing on cosmetic projects instead of systemic change. This leads to greenwashing, which is misleading stakeholders about real sustainability progress. And when it's discovered, investors will gradually pull out their funds and take it somewhere else where ESG is systematically implemented with real key performance indicators. So to avoid this, you have to ensure data is verified, targets are specific and time-bound, and governance is transparent. Very important, especially the governance, because It's the governance structure that will ensure that every other decision of the board with regards to ESG is systematically implemented. And also communicate both progress and challenges is very important. And authenticity, not marketing, wins long-term credibility with regulators, investors, customers, as well as employees. Okay, a quick look at a practical roadmap. In practice, companies can start ESG implementation with a 12-month roadmap. First and foremost, you have to conduct a stakeholders and materiality assessment. Thereafter, assign an ESG lead and board oversight. Once that is done, the next is set baselines and collect data for 3 to 5 key performance indicators, that's KPIs. After that has been achieved, the next will be now to launch pilot sustainability projects that is systemic. After that, publish a first disclosure aligned to GRI or IASB standards. This phased plan ensures steady progress without overwhelming resources. To conclude, ESG is no longer optional. It is a business necessity. Begin with materiality, governance, baseline KPIs, then scale your program over time. For Nigerian companies, align with regulators like the Securities and Exchange Commission and global frameworks like IFRS, ISB, or GRI will future-proof operations. Please leave your questions in the YouTube or comment section, and also you can contact the IC official WhatsApp line. I will personally respond. Your questions will guide future videos. And for more personalized consultation, further guidance, and additional resources on environmental, social, and corporate governance, visit our website to access detailed guides, case studies, and expert insights designed to keep you informed of the latest regulatory updates and best practices. You can also partner with us to leverage our deep industry insight and take the next step towards environmental, social, and corporate governance implementation. Thank you for watching, and don't forget to download this presentation for your future reference. You can also subscribe to our YouTube channel for more valuable content like this. Thank you.